Hello and welcome to the Campus USA Credit Union webinar on understanding credit and credit scores. My name is Caitlin Gertner. I'm with the marketing department here at campus. We also have Alex Gonzalez and Christy Holland joining us. They are managers out of our Tallahassee area. You'll notice that you can hear and see us, but your cameras and microphones are turned off. However, if you have any questions throughout the webinar, we would love to hear from you. Feel free to put them in the chat box and we'll either answer them there or we'll bring them up to the group to address them. Also, at the end of the webinar, there's a very brief survey. We'd love to get your feedback on the content today and any other topics you may want to hear about down the road. Today we'll be covering a few different things. What is credit and how do you establish it in the first place? What is a credit report and what is my credit score? How do they differ? Where do I find them? Why is good credit even important in the first place? And if I have good credit, how do I maintain it? And if I don't have the best credit, how could I rebuild it? Alex is going to start us off by telling us a little bit about what credit is.
All right, yeah, thank you, Caitlin. So what is credit? Credit is the ability to borrow money or access goods or services with the understanding that you'll pay back later. A good way to think about this is a credit card. So a credit card is something you use to pay for items and you're actually spending money that belongs to your creditor and then you actually pay that back later. The creditors will grant credit based on their confidence you can be trusted to pay back what you've borrowed along with any finance charges or interest.
Thank you, Alex. So we have a quick poll up on the screen. We're just trying to get an idea of kind of what your credit portfolio looks like. What experience do you have with these different forms of credit? If you don't mind taking a few moments, you can select more than one option. You can select any of the items that apply that you currently have an account with, a credit card, a loan, and there's a few options on here. I know I have probably 3 of these options. How about you guys?
I am, let's see, 4 out of 5.
I am 4 out of 5, but we just paid off a personal loan, so.
Okay,
Nice.
all right. Well, I'm going to end the poll here. I see some results coming in. I'll share these with the group. So it looks like we have some credit cards, student loans, and auto loans. So thank you guys for sharing that.
Awesome. All right. So now that we know what credit is, why is good credit important? So having a good credit score can save you thousands each year in interest and finance charges alone. It can help you save money when you're buying a car. By reducing your interest rate, you'll pay less interest, and which leads to a lower monthly payment. When you go to obtain insurance, it can result in lower premiums since the insurance companies will pull your credit to determine what premium you get. And then for cell phone and utilities, if you have good credit, typically you won't be required to put down a deposit. So that can save you quite a bit when you're signing up for those services. And then most importantly, nowadays, when you're trying to get a job, more and more employers are running credit before they hire. So it's actually really important to have good credit when applying for that dream job. And just remember, a better score will lead to a better rate, easier approval, and higher limits.
Yeah, absolutely. I can attest to the buying a car and having credit. So I went to buy my first car probably in college and went to buy it, but I did not have credit. So it wasn't a matter of good or bad. It was a matter of any credit history at all. So you'll find that these things are important and you learn them either when you need it, but we're trying to educate you before that happens.
Exactly. Yeah. So let's talk about how to establish credit. So the easiest way to establish credit is to apply for a secured credit card. Now, this is just a standard credit card that you actually put down a security deposit against to help reduce the risk to the lender and increase your chances of approval. Here at campus, we really recommend these for first-time borrowers. So when somebody comes in and they have no credit, starting off with a secured credit card is a relatively low-cost, easy way to get going with your, getting your credit established and establishing a credit score. And that security deposit is usually just money that you'll put down on hold with the lender. You can also become an authorized user on somebody else's credit card. So this is where you're actually issued a card on their account. It's not your account, but you have a card to be able to use it and it does report to your credit. You can also co-sign on an installment loan. So this would be most commonly a vehicle loan or a personal loan that you pay back in monthly installments. And just like, since we're talking about establishing credit, I know how I established credit. I signed up for a credit card when I was 18 years old. What was your guys' first credit experience?
Mine was also a credit card. I remember I was working at Publix and I got a card to pay for my gas. And so I did my gas and paid it off at the end of the month.
Nice.
Yeah, and as you know, mine was that first auto loan. So I did end up having to have a cosigner on that, like you mentioned.
All right, so now that we know what credit is and why it's important, you might be wondering what exactly is in my credit report. Well, your credit report contains a variety of information. It contains your personal identifying information, your account history, bankruptcies and collection items, and it shows your credit inquiries. Now we're going to take a look at a sample credit report, but keep in mind that the format of the credit report may differ depending on where you pull it from. So on this first one, let's take a look at the top. And this is going to include your personal identifying information. So that's your name, your date of birth, your address, and social security number. Followed by that, at that first star, it includes the applicant's credit score. Now on this credit report, it is on the first page, but depending on where you pull it from, it could be on the last page. But 743 is a good credit score, so good for this applicant. And then followed by that is the trade summary. So the trade summary is just a snapshot of all of your current open accounts. So for example, like this applicant has 2 open auto loans and it shows 11 open revolving lines of credit. So most likely those are credit cards. And then if you go to the top of the next page, it's going to include a derogatory summary. So any late pays that you have that are 30, 60, or 90 days late, it's going to show up on your report along with any accounts that have been sent to a collection agency. It will also show any bankruptcies or other judgments that have been reported against you. And then if you look at the third star, so this is your account summary. It's going to show you more details about all of your current loans and all your past loans. It's going to show you the name of the lender, your loan amount or your current balance, and your payment amount. And then it will also show on here how many, if any, late pays you've had with that specific lender. And then normally on the last page or at the end of the credit report, it does show all of your credit inquiries. So these are any loans that you've applied for or any time that you've had your credit checked. It's going to show up on your credit report. It's going to show you the company that pulled your credit and the date that it was pulled. And these credit inquiries will stay on your report for 2 years. So credit bureaus are also known as credit reporting agencies. The US has 3 major credit bureaus, and that's Equifax, Experian, and TransUnion. You can get 1 free credit report per year from each credit bureau at annualcreditreport.com. Anytime you pull your own credit, like through this website, these pulls will not show up on your credit report.
So we're going to do another quick poll here and get an idea of how often you keep a pulse on your credit score. So we've got the question here is how often do you check your credit report? So a formal credit report, like Christy mentioned, say from annualcreditreport.com, do you check it once a year? There's lots of options here that you can select. Right now, as Christy said, you can have 1 free annual credit report, but prior to or during the pandemic, you could have more due to some of the fraudulent activity that was unfortunately occurring at that time. So if you'd like to participate in this poll, you can go ahead and answer it now. We'll close it out and share the results. So we have a few times a month or more is one of the answers here. So that's great. We're actually going to share what we do. While we don't always pull our credit report, our formal credit report, myself, Christy, and Alex have talked about this before. We have some apps, we use different ones where we get a general idea of what our credit score is. It may be linked to your credit card, or there's some other ones that Alex will talk about later. But it will give you an idea of what the score is. And if you were to see a significant dip in that score, that would be a good indication to maybe pull your report and see why that may be.
Yep, absolutely. So what is a credit score? So the credit score is a 3-digit number used by creditors to determine risk when issuing a new loan or a credit card. So these scores will typically range from 350 to 850. Now, each credit bureau uses their own formulas depending on the type of credit you are applying for. And this is why your score can sometimes differ from bureau to bureau. Your TransUnion score might be different from your Experian score, let's say. Now, the most widely used scoring model is called the FICO scoring model. Now, Caitlin just mentioned how we check our credit using an app. The app that I use is called Credit Karma, and it is an excellent app for monitoring your credit. I get real-time alerts if my credit is ever pulled. If there's a new account on my credit, I get alerted to that right on my phone. So it's excellent for that. It also gives you your Equifax and TransUnion scores, but something to note is the scoring model that Credit Karma uses is something called Vantage Score. And so that's going to be a different calculation than that FICO scoring model. So when you're looking at your credit score on Credit Karma, it might be different than if you apply for a loan with your financial institution.
Thanks, Alex. That's great information.
Yeah, absolutely. All right, so now that we know what a credit score is, let's talk about how it's calculated. So these are the factors and how much they make up of your credit score. On the next slide here, we're actually going to break these down individually so we can better understand how those scores are comprised. All right, so the most important factor of your credit score is your payment history. Do you make your payments on time? So when we looked at the credit report, the sample credit report with Christy, we saw that column that showed the payments and the on time 30 days, 60 days, and 90-day late payments. So ideally, we want to be always in the on time column.
Yeah, and we're going to do another quick poll here. This is our last one. We just kind of want to test your knowledge. So a past due payment of 30 days or longer can drop your credit score as much as how much? Take a guess here. We're going to give you the answer, but if you were past 30 days due on a bill, how much do you think it could drop your credit score? Up to what number? So we've got one answer in here. We'll give it a few more seconds here, let people guess. Alex is going to share with us what the number is. We'll close out the poll. So we have one guess for 50 up to 50 points. Alex, you want to let us know what the answer is?
Yeah, very close. So actually one late payment of 30 days can actually drop your score up to 100 points.
Yikes.
So
Wow.
that's why it is very important that you pay your bills on time. All right, so our next factor here, our next biggest factor is credit utilization. So this refers to how much credit you're using of your available credit. The lower the percentage, the more benefit to your score. As a quick example of this, let's say you had a $1,000 credit card, and at the end of your statement, after you've made your payment, you carry over a balance of 200 to the next billing period. That means that balance that's reporting to the credit bureau will be 200. You're currently at 20% utilization. And the way you figure that out is the amount on the card, so the balance of 200 divided by the available credit limit of 1,000.
Isn't there a good rule of thumb here too, Alex, and what you want to keep the utilization under?
Yeah, usually you want to keep it at around 30% or less, but honestly, the lower the better.
Great.
And then the next factor is the length of credit history. So this kind of refers to how long you've had your credit. This is why it's very important to keep those old trade lines open because those can kind of prop up your length of credit history. So like I know in just my personal experience, that credit card that I opened to establish my credit, I actually still have that credit card to this day. So I've had it since I was 18. It is still open. What about you guys? Is your first established credit line still open?
It was until I went to use it and they closed it on me because I hadn't used it in so long.
Oh,
So
no.
unfortunately, I lose all that credit I got from when I started it at 18.
Yeah, unfortunately, that's an easy thing to have occur. I would say that the same thing occurred for myself.
Yeah.
Sometimes those cards end up in the back of the wallet and you don't use it. And they will eventually get canceled. So do as we say, not as we do
Yes.
in our cases. But
Yeah.
Alex, don't you have a good tip for how to stay on top of that?
I do, yeah. So what I usually tell people is kind of have a card for each purpose. So let's say you have one card for your groceries, one card for your gas, one card for your online purchasing, and just make sure you're using those cards at least once a year, and that will prevent your creditor, typically will prevent them from closing the account on you.
That's a good tip. Thanks, Alex.
Yeah, you're welcome. So the next factor here is going to be the length of credit history. I'm sorry. The next factor is the new accounts and inquiries. So this is talking about how many new accounts have you opened recently, and have you had your credit pulled numerous times. So typically, one of the tips that I tell my members is, if you're car shopping, multiple pulls will not actually affect your score after that first pull within the first 14 days of that first credit pull. Now for mortgages, this actually goes up to 45 days. So when when you're going and trying to shop for a good rate, you can pull your credit multiple times. It's going to show up on that credit report all the times that it's pulled, but only the first one will actually affect your credit score. And that's something that a lot of people really just don't know.
Mhm.
All right. And then the last factor is the type of credit and credit mix. So this would mean having both installment type credit. So think your auto loans, mortgage loans, personal loans. These are loans that you pay back in monthly installments. They have a set term or end date. And you just make that payment every month. And you also want to have revolving accounts. So those would be your credit cards and your lines of credit. So these types of credit accounts, you can actually continually borrow up to that limit. So if you have $1,000 credit card, you can spend 1,000 on it, pay it down, and spend 1,000 again. So that's why it's called revolving, because it just keeps going.
So credit scores, most credit scores range from 300 to 850. So the higher the credit score, the better chances you have of getting approved for a loan, and you're also going to get the best interest rate. A low score indicates that you may have a hard time repaying a loan. So that's going to decrease your chances of approval, and it's also going to give you a high interest rate. So let's take a look at the cost of having a low credit score. So in this example, this is on a $350,000 mortgage loan over the course of 30 years. So at the highest credit score of 740, they're going to have an interest rate at 5%, and their monthly payment is going to be around or just over $1,800. If you look at the lowest credit score, which is 659 or below, that interest rate is going to be 7%. So that's only a 2% difference, which may not seem like a big deal. However, that little increase increases the monthly payment by $450, and it will also cost the person with the low credit score, it will cost them over $161,000 of interest over the life of the loan. And so that is a lot of money that you could be spending each month on other things besides going directly to interest.
Yeah, absolutely. The monthly number seems significant, but then when you
Yes.
multiply it by 30 years, I mean, you can really see how a 2% difference, which doesn't feel like a lot when you're getting that loan rate,
Yeah.
really can have an impact.
Absolutely. So now looking at credit cards and paying your minimum payment, we see here an example of a credit card with a balance of right under 3,300. Now, if the borrower here only pays their minimum payment, which is $35 a month, it's going to take them 12 years to pay off this balance. After that 12 years, they will have paid almost double what the original balance was. They would pay $6,800. Conversely, if they pay $123 a month, you see that they knock down 9 years. So they'll only take 3 years to pay it off, and they'll actually save $2,400 in interest. So the moral of the story here is try not to carry balances on your credit cards. They are typically the highest interest rate consumer lending product.
So let's look at some pricing ways that you could be damaging your credit score and not even know. So service contracts. So those are going to be like your utilities or your internet provider. Sometimes when you move, you may miss a payment, or if you don't return the equipment, your account will be sent to a collection agency. And I have a good example for that. So when I moved up here to go to college, I remember like one year we were moving, we were switching providers. I put all of the equipment in the back of my car in the trunk, and I totally forgot about it until I started getting these letters stating, if you don't return your equipment, you're going to be sent to a collection agency. So I returned it and I was good. Nothing's on my credit report, but that is something that will happen and people don't even realize. And then the same with moving. So if you're renting an apartment and you think, oh, well, maybe I can just move out early and not pay last month's rent, or maybe there's damage to the apartment and you don't want to pay for those damage fees. If you do not pay them, they will be sent to a collection agency. And this is actually something that we see a lot of these days.
Yeah, absolutely. Another surprising one is membership cancellation. So this is one that a lot of people don't think about, but if you enter into an annual contract, let's say with a gym, and you decide after 3 months that you don't want to, pay anymore to go to the gym, if you don't follow like their procedures for cancellation, they can send your balance of the remaining year to the credit reporting agency in the form of a collection, and it will show up on your credit report. And then also one that we actually do kind of see quite a bit is cell phone collections. So if you don't pay your cell phone bill and you think, oh, no big deal, I'll just get another phone number, I'll get another phone. No, that will show up on your collection, on your credit report as a collection. And then also like if you have a phone, payment, and you don't pay off that balance, that will also report as well.
Yeah, and another one is medical bills. So even if it's a planned trip to the hospital, like a pregnancy or delivery, or unplanned trips to the hospital, there sometimes can be multiple bills involved. It could be maybe the ambulance, it could be the hospital itself, the doctor on staff. And so it's a lot to kind of sort out. And if you miss one of those bills, or if you choose to not pay one of those bills, that's another thing that will most definitely show up on your collections report and hurt your credit score. It's important though to make sure you've got all those bills covered. Maybe it's unintentional that you've missed one since there are so many. So never hesitate to reach out to the financial department within the hospital that you were treated at, and ask them about all of the bills and possibly even a payment plan for them that could decrease the costs.
So the first step to rebuilding your credit score is to know what is on your credit report. I always like to say you can't fix something if you don't know that it's broken. So I suggest going to annualcreditreport.com and pull in your report, take a look at it, review everything. Make sure that everything that is on there is actually yours. If you do see any errors, you can dispute those with one of the 3 credit bureaus. You don't have to report to all 3. If you just do it to one, they'll do it to the other 2 for you. If any accounts have been sent to a collection agency, you're going to want to contact that agency. Most of the time, they will be more than happy to discuss different payment options and things like that. Another way to rebuild your credit score is, like Alex mentioned before, pay your bills on time. That is the most important step to maintaining and rebuilding your score. And then, like he also mentioned too, applying for a secured card or a secured loan. These types of loans are a lot less risky for lenders because the loan is secured by the funds that are already in your savings account. So it's a lot less risky for them. So here at campus, we are happy to help in any way that we can. So whenever you stop by our branch to either open up a new account or to apply for a loan, we will do a credit check. If you would like, we'll sit down, we'll go over your credit report with you, and we can give you suggestions on how to improve your credit score. We may suggest opening up a secured loan or a credit card. We may suggest refinancing your current auto loan to get a lower rate, or we may just say, let's wait a little bit. Let's pay off your current debt before opening up any new lines of credit. But no matter whatever your situation is, stop by one of our branches and any of our campus representatives will be happy to answer any questions that you have.
Well, this concludes our webinar, and I would like to thank you guys for joining us tonight. Thank you, Christy and Alex, for taking the time to educate us as well. If you do have any questions at this point, feel free to put them in the chat box. We'd be happy to answer them right now. Or if you think of something after this webinar, feel free to email us at feedback@campuscu.com. Also, as an attendee, you will be getting a follow-up email that'll have this recording as well as the presentation with it. So anything that you think you may forget after today, you will have access to. We'd also love to connect with you on social media. If you're on Facebook, Twitter, Instagram, or you can also follow our YouTube videos for recordings such as this. And we'd love to connect with you there. Thanks again for joining us.